So the easiest way that I like to explain term insurance versus permanent insurance is comparing it to like renting an apartment versus owning a home.
All right, we're back in action, episode 90, yellow colored glasses. We've got Austin back in here, and we're going to pick up kind of where we left off on our episode. I don't know, I think it was maybe episode 88, 87, somewhere in there. And today we're just going to do an insurance review, all right, over lots of stuff. But I'm going to get started with a review, all right. We have this one. We greatly appreciate Dusty and Amanda. We were with our previous insurance company for over 25 years. Dusty and Amanda made great improvements with our vehicle policies and homeowners insurance. They helped us improve our policies with better coverage and better pricing. We highly recommend Warren and Mount's agency. That's from Jana. So thanks, Jana. Glad we can work with you.
Good job, Dusty and Amanda.
Yeah, that was definitely more Amanda than it was me. So anyway, with that, we go straight into the peak and the pit. Mm-hmm. All right. You better at this one now? You got your peak?
I got it.
Okay.
Peak, yeah. So everything home-wise moved in. Now it's just kind of making the house ours, which is very, very fun. So I'd say that's my peak. We're all settled in. All our boxes are unpacked or in the basement. And now it's just kind of the fun stuff of customizing it. So that's been a lot of fun.
Perfect. Peak for me, I do a lot of sports peaks and pits. I have a peak that's a sports one. The Royals are absolutely rolling this year, off to the best start since 1970-something. And for me, that means I get to plan what I want to eat that night, where I want to watch the game.
It's exciting.
Kind of drink I want to have, basically what we're grilling. So those summers back in 14 and 15 were absolutely amazing, and bringing that back a little bit. So it's been fun so far. That's my peak.
Gosh, you mentioned grilling. I'm going to have to grill something. That sounds really good. Pits. So pit, I would say two front. One, not having enough time and or money to do everything we want to do, which is kind of it's also a good thing. We need to plan it out. But so that's one. And then the other one is that with all of this stuff, including kids, it's limited or completely deleted my ability and time to play golf. So that's a little bit of a pit, but as my wife would say, I will survive.
Yes. Dude, I've survived a little while without playing golf.
I don't know how you do it.
Oh, well, honestly, I had kind of put it out of sight, out of mind until you started working here, and the golf conversations became much more prevalent. And then that pretty much made me get excited about it again. So
I'm the same way. With all the move and everything going on, I've kind of stopped thinking about it, and it does make it easier. I compartmentalize it, put it away, and I don't think about it. And then Jake, or actually us going to golf with Jeff, has got me fired up again.
Yeah, I'm afraid of how bad I'm going to be and how long it's going to take me to get back into it.
Here's the reality for everyone listening. There are 500, maybe 1,000 really good golfers out there. The rest of us are just trying. We're just out there trying.
Yeah.
It doesn't matter.
Yeah. Well, I'm going to go with that as my pit too, because I can't really think of anything else. Soon to be a peak though, right?
That's what I'm talking about. I love that attitude.
Well, let's pick up where we left off. We ended the episode that we were doing. We kind of touched on a lot of things, but we kind of ended it a little bit abruptly. And we had talked about umbrella coverage, but we didn't go super into detail on why that's important, how it, different scenarios of how it can really impact you as an insured, and why it's really, really important that you have that. So let's start there. Go into more detail and explain what having umbrella coverage is and why it's important.
Yeah, so again, to kind of touch on it, I think that we hit on a lot of important stuff, but today's podcast really is to dive in more about what we talked about. So an umbrella policy is one of those things that's it's not as common or as well known as other types of insurance, whether that's because prior agents haven't talked about it or it's just not something that's required. But an umbrella policy, again, is a separate policy, but covers protects you above your limits for your auto policy or your home policy. So an example I like to use, neighborhood kid riding their bike on your driveway, slips, falls, breaks an ankle. And we'll say your home liability insurance is $500,000. Total lawsuit damages is $700,000. So in that case, your home policy would pay out $500,000, and then the extra $200,000. Where does that fall? And like I said previously, the first option would be you don't have it, and then potential lawsuit, garnish wages, garnish assets. Either way, not fun. Or you utilize the umbrella policy, which is to start out with at least $1 million extra, and it would kick in to cover that difference. In my example, $200,000, and you can go up a lot higher, depending on how much assets you have and what you need. But baseline, an extra $1 million. Typically, it is $200, $150, $200 a year, and obviously, pros and cons of that: $200 for a year or $200,000. Pretty easy no-brainer. So it's one of those things that we like to bring up a lot. You have to have certain limits to be eligible for it, as far as your home and your auto policy. But it's one of those things that if you ever need it, it is worth every penny you have. And I'm a big advocate for them, whether you're young, just starting out, or if you're close to retirement. But especially with being close to retirement, the last thing you need is a 6-figure setback to where you have to keep working, or you're not able to live the same lifestyle you want in retirement. So again, the goal with insurance is to make sure that you are protected, worst case scenario, no matter what happens, and umbrella policy is a really, really good way to do that.
For sure. So I think that and we're going to go into coverage needs across the board, but I think that it's important to give people some scenarios and some things to, like, hey, here's an example of why this is really important. And there was a post that was made on May 15th, and it was a State Farm agent that I'm friends with on Facebook. And it was a very, very interesting post, and I think it's important. I want to share it with people. And I don't know that every single ounce of this is true. I'm assuming that it is. Okay, I'm crediting the agent that posted it. This is not one of our insureds, but in essence, it was the son of a client of the insurance agent, and the client had been with this specific insurance agent for many, many years. His son was grown up, was going out, and he was purchasing his first home. In purchasing the first home, he put a policy together, gave it to the potential insured, and the real estate agent then advised the person that's buying the house that there were coverages on that policy that were not needed. All right, essentially, kind of overstepping their lane and trying to do the insurance agent's job.
So the real estate agent told the home buyer,
hey, you don't need that stuff.
Got it.
Okay,
and that was the umbrella?
No.
Okay. Go ahead.
So on the policy, he had written it for obviously the correct dwelling coverage, but he also had $1 million in liability. Mm-hmm. Well, they're trying to shop numbers, get the cheapest rate, all that stuff. The insurance or the insured chooses to go elsewhere. And recently, one of his friends slipped and fell at the house, I believe it was on the steps, and the homeowner is now being sued for $750,000. Turns out the insurance agent that he chose to go with only put $100,000 in liability. Therefore, this 24-year-old is now responsible for the other $650,000 that he's being sued for. Most likely will have wages garnished. Mm-hmm. It will affect him for, honestly, the rest of his life, because in this time frame, 24, you're just getting started out, don't have a lot of money, not very far in your career yet. This is a true example of an absolute disaster.
Fantastic example.
And
unfortunate, but a very good one.
And it's something that doesn't happen. I mean, you don't think about that happening.
No.
This is why it's there. And that extra coverage, okay, we write $500,000 as our standard of coverage on liability. The umbrella that you're talking about typically is an extra $1 million. Mm-hmm. Okay? This would have taken care of it. This is why you have it for an extra $200 a year, $300 a year.
Well, another thing, set aside the umbrella, the difference between $300,000, $100,000, and $1 million just on your base home policy, it's couple dollars a month typically. So it is not a make or break. So if the real estate agent is trying to get budget down, I understand that, but there are other ways to do it that are going to be more cost effective. The amount that reducing that, it doesn't change the price a ton. So it's again, it goes back to a no-brainer, but it's also making sure that you are getting advice and recommendations from credible people and people that know what they're doing. I'm not going to go tell someone they shouldn't buy a house because of this, because that's not my specialty, right? And I think that's why you need to talk to people that are in their profession. But yeah, that's a very good example, very, very unfortunate example.
Well, and one of the things too, and this is not us bragging at all. Like it's important, I think, for people to realize that was a real estate agent that said that. There are also insurance agents that they'll put whatever you want on the policy to get it whatever price you want because they're trying to get the sale.
Yeah.
Okay, there have been so many conversations that we've had with customers. Like, we are not about getting you the cheapest rate. We're going to get you the cheapest rate we can with the appropriate coverages. And I think that the education piece is important.
Yep.
And I hear you on the phone. I mean, all of us in the offices, from the moment that we opened our doors, that was a non-negotiable for us, was we are educating the client on why they're paying for these coverages.
Yep.
So, yeah, it's super unfortunate because that is you saved a couple $100 and it cost you, hundreds of thousands of dollars.
Yeah. And I think education piece is important, but we also don't expect you to be experts by the end of a conversation, right? One time you're not going to be 100% knowledgeable and retain everything, but that's also why we're there in the future too. After we start working together, but yeah, it goes back to what we said in the last podcast. It just doesn't make sense for us to write anything less, because having a call like that with one of our clients is very, very tough. That would be hard to take, and it's all avoidable.
Every bit of it.
Yeah, don't go out to eat once a month, and you would avoided it. That's it.
So that being said, we've just talked about umbrella, but let's talk just briefly over just general coverage needs. Okay, so when we write the home and auto, talk about our standards of coverage that we're doing. And honestly, this instance made me think, man, our standard is $500K.
Mm-hmm.
Do we need to bump that thing to $1 million for especially like you just mentioned, the money that we're talking about?
Yeah, well, and it also depends. Some carriers won't go up to $1 million on the home policy, but yeah, I definitely think it's something to consider. I think $500,000 is a good starting point. But yeah.
And then you throw that umbrella on there.
Yeah. But yeah, so our standard, the lowest that we will write here in the office as far as an auto policy is $100,000, $300,000 if it's split limit, or $300,000 for combined single limit. And the state minimum, at least here in Missouri, is $25,000, $50,000. So they require $25,000, $50,000. But even the example I like to use, because everyone, if you say, well, hey, if you injure someone, it may be more than that $25,000. That's a little easier to rationalize in someone's brain, like, oh, that's not going to happen. But let's just use the example of property. So, and to kind of give it what I'm saying, $25,000 is if you got into an accident, you injured one single person. $50,000 is if there's multiple people involved, and then the third number that you guys will see on your deck pages is for property. And so state minimum $25,000, $50,000, and then property's $25,000. If you go and hit a 2024 Suburban and you total that thing out, that can be easily 60, 75, 80. Yeah, it's not uncommon. And so it's the same situation. That is, I think, a little bit more easier to understand from the client's perspective. There's, even those new Jeeps, big ones, those are six figures easily.
Yep.
And so again, it goes back to educating them, making sure that they understand even what those numbers mean, but also painting a picture, giving examples to where, holy cow, yeah, my neighbor drives a 2024 Suburban. Like, I mean, that happens all the time. So the value of the vehicles now is crazy, and you can easily get into a position to where, you save $10, $15 a month, but now you're 50, 60,000, then they're trying to come after you. So I think it goes back to educating and making sure they understand. But we just do not see the value in writing anything less than that. Because again, we wanted to do what's best for the client, but we also want to make sure that they understand that we're so adamant about it that we're okay if you walk away and want to go work with someone else.
100%.
That's 100% your choice, but that's where we draw the line we won't go from, and I appreciate it.
Well, I think it's important too to then go into the uninsured and underinsured coverage that we recommend too, because
It's huge.
like we're talking about, we want you to be covered correctly, but on the flip side, we just told you there's a lot of people that drive around with state minimum and a lot of people that drive around with no insurance, and they don't give a crap. They don't care. Mm-hmm. They think that that's just they do not care about what's going on with your situation. So somebody hits you and they don't have the correct coverage. Well, now instead of having to, wait on them or go through a lawsuit with people who, maybe they can't even afford it, maybe there is nothing to sue them for, right?
Lawsuits can take
years,
5-10 years easily.
So then you've got that coverage on your policy to where, hey, they weren't covered correctly, but you've got the same exact limits for an uninsured driver or an underinsured driver, and that helps you tremendously in the short term. And then the insurance company deals with that on the back end, right? So that's a very, very important coverage too, and I think sometimes people don't realize what that is, and it's very, very inexpensive.
Yes, but that is something that is overlooked a lot. And I always get these confused, but uninsured is required, right? That is one. Underinsured is not. Is that the one you can take off? I always get what you can.
I feel like we can leave both of them off. Now you can't have uninsured on there and it not match your current rates.
Yeah, but so
your current coverages.
When I'm looking at clients' policies, a lot of times I see one or the other. They'll have one on there and they won't have. But again, the reality is, cost-wise, it does not cost very much, and it makes sure that if someone hits you and has state minimums, they don't have enough insurance, they are underinsured. Like you said, there is some type of coverage that's going to take care of your medical needs, and then if they're completely uninsured, again, it goes back to having limits that's actually going to pay out and handle something. So both those are very, very valuable. Again, all very easily overlooked. A lot of people, when they're shopping or looking around for quotes, they look for price, right? Which is understandable. Again,
especially in today's market with the way things are, I get it.
Insurance is not one of those fun things to pay for. You don't see it coming out each month. Man, that was, loved it. Glad I got to pay for insurance this month. But so they want just price, and I understand it, but if you do anything, you go to the mechanic and one person says, hey, it's going to cost you $5,000 to get your car fixed, the other one says $500, you're going to get what you pay for, right? That is always the case. You're going to be back in the body shop in a week if you pay the $500. So we are all about a balance of adequate coverage and price. Trust me, we want to get your prices down too, but it goes hand in hand. We can't have one without the other.
No doubt. What about any of the extra coverages? Let's just touch on like roadside rental. Okay, I know this is this isn't like the huge deal, but one of the things I want to highlight too is when we put on roadside. All right, in my experience, and I know it's not years and years and years, but anytime somebody gets roadside, most of the time it seems like whenever you actually need it, you're off in the middle of freaking nowhere. Mm-hmm. So this is another example of a very, very cheap kind of an additional perk or benefit that you may see on your policy when you're looking at price and be like, oh, I can take that off. And I'm talking about like going versus zero roadside, maybe the standard, which is like 15 miles, versus then going to the premier, which is 100 miles, or with certain carriers, maybe it's up to $400 or up to $300. Mm-hmm. If you're going to have roadside, get the extra, because then you're not worried about it. And you don't even have to call the roadside for the actual insurance company. You can call one that's really close, shoot us over the receipt, boom, we send it to the insurance company, and you're reimbursed.
Yeah.
see it happen all the time. People who choose not to do it or think they need to cut it, then they're out in Columbia, 2 hours from home, and they're needing it. So that's another one. Add that on there. It's an extra $10 a year,
Yeah,
$20 a year.
I was gonna say the difference between 15 miles and $350 or whatever the Premier is going to go from like $8 a year to $18 a year, right? It's
no brainer.
Yeah, again, you can cut price, but you got to think if it's worth it. And rental car coverage is the same way. There's a lot of people that take that off, and they end up needing it, and they're ticked off that they don't have it. Now you save $10 a year, and now you got to pay hundreds out of pocket. So those are not as necessarily as big or bigger ticket items, but yeah, I'm glad you brought them up.
Yeah, they're not something that's going to wreck you financially, cause a huge financial burden if you don't have them. But my goodness, put them on there, and you'll be happy that you did. All right, anything on auto, home, basic PNC stuff? Anything we want to touch on?
No, I just kind of wanted to go over, I think, the importance and why we value them, where we're at, and we really do have the client's best interest in mind. I think that's, you can come in and talk to us, and you're going to get the same responses, the same attitude overall from any of us, which I appreciate. And it, quality over quantity, we will take all day. We want good clients. We want good relationships with the clients. And the way we do that is by having those standards, and you start working with us, clients understand and know that we are taking care of them. We plan to be around for a long time, and although we want to continue to grow, we also are okay turning people away. But that ends up resulting in clients staying with us for a lot longer. They're not going to flip back and forth to different carriers because they know that we'll handle it all for them and we'll do it correctly.
Yeah, no, and we've said it over and over again since opening. That's why we have such a great client base, because we have great clients that also appreciate being educated.
And even the ones that leave, it's because of a must or something changes because they have to a lot of times, right?
Yeah.
You can call any of our clients that have left, and I bet you would not have very many, if any, that had real issues because of something that we did on our end, which is huge, I think. And it speaks volumes. But
yeah. Well, let's get into a little bit deeper dive on life insurance. We just, I think, briefly touched on it whenever we were on the last podcast. So, different types of life insurance. Essentially, you've got term and you've got permanent. Okay, and within term is term. Within permanent, then you have different products in different ways. So let's go into some of those. Explain. We talked about having a great defense. Okay, before having a great offense last time. Go into depth a little bit on how term life insurance is the foundation for that great defense.
So the easiest way that I like to explain term insurance versus permanent insurance is comparing it to like renting an apartment versus owning a home. So when you think of term insurance, think of renting an apartment, right? It is set for a certain time limit, certain number of years. Typically when you rent for 1 year, it's you get the benefit or the coverage you need, roof over your head, place to live, but it is not. But you don't own that asset essentially. Term insurance is very, very similar. So it is set for a certain time limit, certain number of years, 10, 20, 15, 30. It is going to be the cheapest type of life insurance. Obviously, the death benefit portion of it, whatever amount you have, is going to pay out 100% tax-free. But at the end of that term agreement, 10, 20, 15, 30 years, that money that you've paid towards it has gone towards that coverage, but there's not anything for you to get back. Just like when you end your lease with an apartment complex, you can't get all your rent money back, but it would be nice. So term insurance is a very, very good foundational piece. And sometimes it makes sense to have all of the coverage you need in a term policy, and sometimes it makes sense to have kind of a combination of both. A lot of times it depends on budget and goals, but term insurance is a very, very good way to get the coverage you need, your family needs, and to make it more budget friendly. You want me to go into permanent?
Yeah, well, I was going to piggyback off that because the thing about term is the cool part. The thing that I love so much is that most term now, I mean, most of it, you don't really find any that's not convertible. Okay, and we'll kind of get into what that is, as we go. But most common, for term is going to be the age you are, right? So, you mentioned that it's the cheapest of the insurance, all right? So term, you're 21 years old, 23 years old, maybe you just getting married, just getting ready to start a family, needing to save money, all right? Perfect. Okay, get term. If you're needing that coverage for the time in your life where if something happened to you, that it would really affect your wife and your young kids, a larger amount for less money monthly. Many people have opinions on, okay, term versus permanent. There's a big debate on that. It's been like that for years. Yep. We've talked about it on Jake and I have talked about it. My specific opinion on it has changed so much over time based on the research I was doing, the opinions I was hearing, Dave Ramsey versus, you got the Northwestern Mutual, and you got people that think life insurance is an investment tool and all that. There is absolutely no correct answer. Okay, that's what it is, all situational, and you've already mentioned that. Your needs for permanent life insurance change as you get older, as you get more money.
Or in life insurance in general.
Yeah, I mean, it changes. And so, let's get into the different kinds of permanent policies there are.
One thing I was going to say with the term, go back to the 21-year-old, right? Just starting out, wanting to try to save as much as they can, whatever. You can stack policies, right? So let's say that 21-year-old has $20, $10, whatever that is, but has a wife or has a spouse at home. You can get a smaller term life insurance policy, and then in 5 years, get another one. And maybe because budget's opened up or whatever that is, but you can always stack it. So you don't have to go in and break budget and get everything done. Something is better than nothing, especially in life insurance.
And that leads to another benefit of that too, which is your health, right? Mm-hmm. So we all know that your health.
So what determines price with life insurance?
Yeah. So if you're perfectly healthy, which most of us are obviously more healthy when we're in our 20s, it's going to be cheaper. Okay. So let's just give this example. That 21-year-old decides to get a $250,000 life policy, and it cost him $15 a month. All right. Does it for 30 years. That's going to take him to age 51. Okay. By the age of 51, his kids are grown. They're out of the house. All right. Home's paid off, most likely. And the need for that insurance has then disappeared by the time you've gotten to age 51. But it covers you for so many years. All right. Those important times. Then let's say we're going with your model. All right. Five years later, maybe you wanted to add $500,000 to that. Okay, well, maybe you set it for 25 years and it takes you to the same age. Maybe you do another 30, it takes you 5 years longer. Here's the only kicker, and the only reason why I say get as much as you possibly can early, all right, is because let's say something drastically changed with his health in those 5 years. Maybe it's something that would have made him ineligible, all right? If you're ever thinking that, and just in my opinion, if you can get it as soon as you can get it, get as much as you can, all right? That does not change anything that you just said about stacking those, or you don't have to break your budget. And the main point that Austin has is something is better than nothing, no matter what.
My main point with that was don't let it stop you from looking into it if you think that all you can afford is $10 or $20.
100%.
Right? There's options and there's ways to work around it. But yeah, you're very, very right. What dictates price for life insurance is all based on your age and your health. The younger you are, healthier you are, cheaper it's going to be. So getting what you can locked in, it only makes sense because $100,000 as a 21-year-old is going to cost you $10, $15. $100,000 as a 60-year-old could cost you $50, $60, $70. I mean, it can go up from there, right? So a lot of different factors, but it is tough because a lot of times life insurance is not one of those things that you think about as you are younger, which rightfully so. We all have expectations of living long, healthy lives. And as you get older, like you said, a lot of times the need goes down, but your awareness of needing life insurance goes up. So it's kind of an interesting dynamic. The middle portion of most individuals' lives is where you are at the most risk for your spouse or your family to really, really hurt if something happens to you. And so it's, life insurance is not meant to make anyone rich, but there's going to be enough emotional burden if there's a death in the family, that the least that we can do or you can do is limit the financial burden that would happen.
Absolutely. So that takes us into a different kind, right? Let's go a little bit of the hybrid, the kind of the mix between permanent and term, kind of the ROP, right? Which actually it's not permanent, but it operates in similar ways. Okay, so
it's a little different, yeah.
Yeah. So let's go to the ROP. Explain that.
Yeah. So ROP,
what's it stand for?
Return of premium. So, and I go back and forth on if I like a return of premium policy, and I can kind of explain why. But some clients don't like the idea. They feel like term insurance is wasting money, right? Even though they understand that there's a benefit for their family, if something happens to them, it's tough for people to make it let's see, what am I trying to say?
They feel like they're not getting anything out of it if they outlive the policy.
Yeah, it's tough to justify it in their mind of why they're spending that much money. Paying money each month, and there's nothing that they're going to get back unless something bad happens, right? Unless they pass away. So return of premium, it is going to be a higher price point. So same amount of money or same amount of coverage you have, which is traditional term, is going to be cheaper than what it would be with a return of premium. The money that you put in, different carriers have it set different ways. Some will not let you get the money back until the end of the term. Some will allow in the middle or different years. But essentially it allows you to get the premium that you put in, and it is returned to you. So it is a way that helps some people justify it, saying, it's a savings account. I'm putting this away for future me. But it's going to be cheaper than a permanent option. It's going to be more expensive than just traditional term, but it does offer some type of financial gain at the very end, or at least recouping it.
Yeah. So an example of this is let's say that your insurance is going to cost you $1,000 a year, and you've got a 20-year return of premium policy. So you're purchasing that insurance. At the end of that 20 years, you get all of your $20,000 back. That same exact coverage, right? Let's say it was for $500,000. If that was just a standard 20-year term policy, maybe it wouldn't cost you $20,000 over those 20 years. But maybe it cost you $12,000 over those 20 years. Mm-hmm. You're spending $8,000 more throughout the life of the policy, but then you're getting it all back. So, yeah, it's money that could have maybe, where people argue that, I could have made more if I just invested that, right? Mm-hmm. This isn't quite like a savings account because a savings account doesn't have a death benefit attached to it. So you're still getting two things there.
Yeah, no, and
so it just makes a difference on what the client prefers.
Yeah, and I think there's ways to argue both sides of it. That, like you kind of hit on. Well, let's say you take that extra $8,000 that you would have spent, and you set up some type of automatic payment to some small investment account you have. That to me, a lot of times I tend to lean on that because I like the idea of having, if my money is going to go out and I'm not going to have access to it anyway, I would personally rather have the option of having an ability to earn more on my money than it just be locked up and I get the exact same amount back. But again, I've had clients where I just can't justify paying $100 a year or $100 a month for term insurance, knowing that the only way it benefits anyone is if I die. That's hard for me to understand. I get it. So return premium then makes sense. It helps them feel like they're getting a benefit, but it also makes sure that their family's getting a benefit. God forbid something happens to them. So there's you're 100% right. It is situational. It truly depends on what the client's needs and wants are, what their goals are, and honestly, what helps them sleep at night. Whatever that is, doesn't matter.
Yeah, and it's not our job to influence you on. We're not going to tell you what to do. Like the thing here, I hope that you're getting is there's options. Right, you have options for whatever fits your thinking. All right, but just like we talk about on the personal lines, educating you on what you're getting and the benefits of both. There's pros and cons to every single thing that you're doing. So it all depends on what fits into your financial analysis, your financial profile, what your goals are, all that stuff. So go into permanent. All right. So within permanent, a lot of people, they hear whole life. Okay. And whole life is the term that probably gets thrown around more than anything. All right. Whole life is not the same as index universal. All right. So an IUL, that is another term of permanent. You're also going to hear variable. You're going to hear just straight universal. There's just different things, and I think this is where consumers most often get really confused because there's so many opinions and so many different things out there on what permanent life insurance is and all the different ways that you can use it. And so I have my preferences on how I think they should be used, but this is once again all up to the consumer. So do you want to go into the differences on some of those, on maybe talk about whole life specifically?
Yeah, so I mean, to kind of go back to my example, to get an understanding of what permanent insurance is, think of owning a home, right? So it is something that is going to be with you until you pass away or until you are 120 plus, whichever comes sooner. So there is not a time period, just like owning your home, right? You're going to be in it unless you sell it or pass away. It is going to be, permanent insurance is going to be more expensive if you were going the same amount of coverage than you would pay into a term policy. Death benefit's going to be the same, right? So if you have $500,000 in a term policy, $500,000 in a permanent policy, you pass away, your beneficiary gets $500,000, right? So that stays the same. But the big key difference, other than how long it is in place for, is what your money is doing on the back end, right? And how you can access that. So whole life specifically, it's more of a stair step as far as what kind of return you're going to get. Typically, it's pretty consistent within the carriers. It's going to be a set rate, or kind of depends on what their
dividend percentage is,
what their dividends are. But kind of the big difference from having money in a permanent type of policy or just straight in the market investing is that it is a stair step. So you take a step up, you have 5,000, you take another step up, you're at 10,000. The money's not going to go backwards. You may not make anything one year, but it's never going to go backwards. So it is kind of going back to that foundational piece. It can be a tool that you utilize to make sure that you have this amount of money that is growing, but is also safe, right? You have everything in the market there, it's volatile. If anyone tells you it's not, don't trust them. But so it's another kind of financial tool. It is not the end all be all as far as retirement or ways to accumulate money by any means, but it is another tool that offers different options than an IRA or any kind of investment account. But that is your area of expertise, not mine. But
so let's just talk about the difference between whole and IUL for a second. So, like you just said, you've got a death benefit that is essentially costing you more money per month on paper of what you have to put into it, okay, versus return of premium or versus term. This is once again one of the pieces that it's all about what the insurer or what the consumer is trying to accomplish with that policy. Mm-hmm. Some folks, they're not really looking at it as it for anything to benefit them whatsoever. Mm-hmm. It's simply a generational, we're passing this on. Yeah. And that's the only thing they care about. That's great. All right. That's not something that 21-year-old that we were talking about is necessarily going to be a necessity at that point for them.
Sure.
Yet. Could be, right? But there's a lot of other things to maybe have in place before you are doing that. I think the biggest thing that I want to hit on is the difference in the way that the whole is set up in the IUL. All right, we mentioned dividends. All right, so if you have a whole life policy, it's going to give you a guaranteed, rate of return on your money that's growing. Okay, those are called dividends, and it's not like dividends with the stock market. Dividends are what the insurance company is then paying the consumer at the end of the year when they go and they evaluate the policy. Austin has a policy. They say, hey, here's what Austin paid. Here's how much he overpaid that year in the insurance. Here's the dividend that we're going to get back. We're essentially putting that money that he paid back into his cash value, and that stacks on the money that you put in there, and it continues to grow. Every company that has whole life, they will have some kind of guaranteed percentage that they will no matter what do. Mm-hmm. Right? Most of the time it's like around 4%. Okay, roughly. On years where it's good, maybe it's more. Okay, maybe they're putting more back into dividends. On the IUL side, it is not funded the same way. You do it as the consumer the exact same way, but your money is actually attached to index funds, all right, and the performances of those index funds, okay, and you can select different ways to invest the money that you're putting inside of that, that tool.
Yeah.
And unlike being in the market with it being very volatile, those indexes, okay, the way that the policy is set up, it will have a floor, right? Typically that floor is like 0%. So what that means is you have a bad year in the market, maybe your money doesn't make you anything that year. And the only thing that's costing you is just the 1% participation fee for being in that product. So you would have lost 1%. Now the pro here is years when the market's really good, it's actually going to outperform those indexes because there's always boosters on those. So when you look at this for somebody that's doing this over 30 years, 40 years, the chances of that performing a little bit better than just a traditional whole life with just those set percentages could be much, much of a greater impact. Mm-hmm. All right, so those are the two different ways that an IUL and a whole life operate. One is dividends paid out by the company. The other one is indexes that are paid back into the policy based on what the market does. Okay, so maybe less guaranteed rate in the index, but maybe more upside overall for outperforming what the whole life policy would do. Okay, that's the easiest way to explain that. Now, the different reasons, excuse me, the different reasons people would get those policies. So on an IUL specifically, you can choose to have your premium fund a higher amount of death benefit, which will make your cash grow at a lesser amount. Mm-hmm. Or you can set it up to where instead of it being your premium pays for the biggest amount of death benefit possible, now we're going to do it for the smallest amount of death benefit possible in order for us to take advantage of taxes. So what that would mean is, like, let's say, Austin, you're looking at getting a $300,000 policy. You want to put $500 a month in there. All right, well, that $500 a month could buy you the $300K, or it could maybe buy you only $150K. The difference is, if you set it up to only buy $150K, that's going to be more money that's going to be in your life policy to grow on a cash basis. And then that gets you into other reasons for using it. Anything that you want to add to any of that so far?
Yeah, I would say just think of the cash as equity, right? That's a good way to put it in everyday terms. And you are essentially taking a policy that could be $100 a month, and you are overfunding it. You're putting $500 in a month. And there's a few different reasons why you would do it. It is a tax shelter, but it is also money that after typically the first 7 years, obviously the longer that you can leave it in, the better, because it is compounding interest, right? So it is better the longer you leave it, but it's something you have access to, which is, a lot of times there are clients that want to overfund it for 10 years, and then they want to let the equity or the cash value fund the policy for the remaining years, but they want to use it as leverage. They want to use it as collateral. They go to the bank and say, I have $500,000 in my permanent life insurance policy, and I want to get a better rate than what I could just get on my own. So there's a lot of different ways, or you can just straight borrow against it. So there's a lot of different ways to leverage it, and like I said earlier, it's not the end all be all, but it is a tool that offers different options than you would get from your 401k at work or a traditional IRA, and there's typically less penalties than you would have if you try to pull money out of your 401k or another investment account. So again, it goes back to what options and what the client needs and wants. As far as investing money, there's nothing that is guaranteed safe, for the most part, right? And so for a client who maybe is getting close to retirement or is just naturally conservative, this may be an option to have your money growing, but not, it makes you feel a little bit better knowing that you're not going to wake up and you've lost it all. 2008, 2009 happens again,
For sure.
something like that. So, there's just different ways to leverage it, different ways to utilize it. And a lot of times it's what's going to make the most sense for the client is going to be some type of combination of these policies, right? So before we start talking about different products for the conversation, we are finding out how much coverage you need, what your death benefit is, right? And let's say it's 1.2 million. That's the amount you and your family need to make sure that they're taken care of. 1.2 million entirely in a permanent policy could be a couple grand a month, right? That's not affordable in the budget. So let's do some kind of combination. Maybe we do 1.1 in term and we do 100,000 in a permanent policy. And like you said earlier, you can always convert the term later on, right? So as far as priority or what goes into a conversation, it is making sure you have the right death benefit, making sure that it is something that's going to be meaningful but not burdensome as far as the budget and how much you're putting into the life insurance policy. And then towards the end, we talk about products. It is important and is going to be valuable, but it's making sure that you have the right amount of coverage, and then we will tailor make the policy or policies to fit your needs and budget and go from there.
Absolutely. You haven't really been around since we were talking a lot about the infinite banking, have you?
No. Jake and I talked quite a bit about it, and it's very, very interesting. But no, I've not been exposed to it enough.
So I need to use the restroom really quick, and then I want to just touch on that because it's super cool, and we've talked about it on here a few times. It is
a very, very interesting strategy.
But a lot of things that you just said as far as leveraging, borrowing, banks, all that stuff, there's some really cool and key concepts. And as we've gone on, I've gotten to where I can talk about it with it not being as confusing.
Mm-hmm.
So I just want to touch on that. Give me 2 seconds.
Yep.
All right, we are back now. Okay, Austin, let's pick it up. We were, let's talk about one thing with permanent policies that is super awesome. Okay, we just talked about differences in the permanent policies and how they might have less fees or penalties maybe than 401k or IRAs.
As far as taking money out.
As far as taking money out, banks, all that stuff. So let's just do this scenario. Think about all the things we finance. All right, our vehicles, our phones, our house, everything. I mean, we finance thousands and thousands, hundreds of thousands of dollars over our lifetime. Most people do. Okay. So a bank, you go to a bank, they charge you an interest rate, and let's just say it's 5%. Well, the cool part about specifically with IULs, you mentioned 7 years a second ago. Not touching it until it's been in there 7 years. That is one thing with whole life that is different than IUL. And you can set certain riders up with a whole life policy, but that gets a little bit complex and confusing. So essentially, with an IUL specifically, if you decide to get a policy that's going to be meant for you to bank with, all right, you would set it up, like I mentioned, to buy the least amount of death benefit, all right? Because you want that to grow at a certain amount that is not taxable. There's what's called a modified endowment contract in life insurance, that if your money grows more than a certain percentage, then that means the IRS, they categorize it as an investment product, which means that it becomes taxable. So you set your index universal life policy up to overfund to the maximum amount that it can without being a MEC, modified endowment contract. Now, you can set it up to where you can borrow from that starting immediately. Most common is to set it up to where you can borrow from it after 1 year of it being in the policy. So let's say someone has $30,000, all right, and they dump that into their life policy. Well, after year one, they would have $30,000 to go borrow from, all right, and let's say that it grows and it's $33,000, right, and you continue to make your monthly premium payments and your money grows and grows and grows and grows. Anytime, and here's the biggest difference between borrowing from your 401k or borrowing from your IRA, is that if you were to go take out $30,000 from your 401k, mm-hmm. that changes it by $30,000 in value, mm-hmm. right? Now, the amount of money that's growing inside that 401k is only growing on $30,000 less, okay, which impacts your returns. Mm-hmm. In a life policy, it's not like that. You pull that money out, your cash value in there does not change. It does not change. So it continues to grow with the same amount, regardless if you pulled that out and borrowed against it.
Yeah.
All right. So that's one key.
So you've essentially got your money working for you
no matter what. Correct. Now, the next step of that is, let's say you were going to go buy a car. You were going to go finance $30,000 from the bank, Ford Motor Company, Kia Motor Finance, whatever it is. They're going to charge you 5% interest. When you make those payments back, you pay that 5% to the bank. You never see it again. If you borrow that from your life insurance policy, yes, you have to continue making your monthly premium payments like you never borrowed from it, just like you always did. But you also have the loan for your own bank. Okay, so you're paying your bank that you just took your money out, you're paying that back with that 5% interest, which just adds to your cash value, which continues to make your money grow at a higher rate. So therefore, if someone wanted to, and we have these set up for both of our boys, and they're not large. I mean, we have $150,000 IULs on them.
Yeah.
But we're going to teach them this from the time they can start learning about it. And when they're 18 years old and they have access to this, yeah, it's not going to be a ton of money, but they can always increase it, and they're going to understand how it works. Theoretically, once you establish this and you fund it, you would never need to go to a bank again. I mean, now, unless it's your, maybe a $500,000 house or something, right? You don't have it funded. But for all of your normal type vehicle purchases, anything that you would finance anything out, you just go to your bank, all right? And think about all the thousands of dollars that we pay in interest over the lifetime of things. When we're paying that to ourselves, that's pretty dang awesome, all right? Now, none of that is taxable, okay? The only way that becomes a taxable event is if the life policy lapses, okay? So that means if you close, it closes out and you didn't make those payments on your loan and you didn't pay it back in, now the money that you withdrew would be taxed just like your IRA or your 401k, if you were to take that before 59 and a half. So that's really the biggest deal to look out for tax-wise. If you operate it like a business, all right, if you operate it just like, you were running your own bank, you have the ability to do some pretty awesome things. Now, that's kind of an advanced strategy that I think that you need other things in place as well in your financial plan.
For sure.
But it's what the life insurance companies literally have been doing for,
well, and
hundreds of thousands of years.
Go back, a lot of the big banks,
Not thousands, hundreds of years.
a lot of the big banks, that is, when they take your money, when you put it into a savings account, you get 0.002% or whatever it is. They're taking that money and they're putting it into permanent life insurance.
100%.
So, the big banks, if they do it, there's a reason they do it, and yeah. So I mean, it goes back to each client and what their goals are, but it does offer a different perspective or a different set of rules than other cash accumulation vehicles can, right? You touch a 401k, you said earlier, before you're 59 and a half, there's a 10% penalty. You're also taxed on it. So you're at your current tax rate plus a 10% penalty. That adds up quick, right? So I mean, you could be losing 40% of what you need to take out. So instead of taking 30% out, that client may have to take 60 or 65,000 out from his 401k, from their 401k, to get the end goal, right? So, this, we're not saying don't invest or don't contribute to your 401k or others. It is just a tool in the tool belt. Then each tool is going to work a little bit differently, but this one does offer some interesting options, and like you said, as long as you know how to use it and you do operate as a business, it's a lot easier to make payments to something set like that than it would be, just to borrow from your own savings account or something like that. But it's an interesting strategy. It's a little bit more high level, but that's why talk to someone about your certain situation, and we'll see if it makes sense.
Yeah, I was looking on my phone just now for a book that I think anybody should listen to that has an interest in banks and investments and life insurance. And it's not really about life insurance, but it's called The Creature from Jekyll Island. And it's essentially about how our banking system in America got started. And it's a really, really interesting read or listen if you're an audiobook type of person. That's how I listen to it, but it's phenomenal.
Another one, have you ever heard The Power of Zero?
Yes.
It's a very interesting one too. Again, it's not specifically about life insurance, but the goal is at the end to have your tax rate, or what is taxable,
At zero.
or as close to it, by having offset, being able to. And I haven't read it in a few years, but that is another one that is very interesting. It's a super easy, short read, but it's very, very intriguing. Just different ways to leverage different assets that you may have, and to ultimately pay the least amount in taxes that you can, which I think we can all agree we would all love to do that.
No doubt. Well, that's all I really have. We did almost an hour on this one. Well, over an hour if you count our break, but
yeah, I would say to end it, whether it's us or another, life insurance agent, just go talk, go have a conversation, find out more. Let us ask you the questions that are going to help you determine what's going to make the most sense and what's not. For the most part, people don't know what they don't know, and that goes for a lot of cases, but especially life insurance. And you may not think you need it, but you think, hey, maybe in 5-10 years I might need it. So why not find out a little bit more now?
The main point that I want people to understand when they talk to us about life insurance is we are going to make sure that you're not confused about it. Because we all know, personally, we've been through situations where we leave a life insurance meeting or presentation, and it makes kind of sense while we're in it because that person is very high level and they talk over you and it kind of makes sense. And the second you walk out the door, you're like, what the hell did I just hear?
Yeah.
And it doesn't have to be complicated. It really doesn't. And I think that, I know you do a phenomenal job with that. We really try to do that across the board here. And yeah, so we had a camera cut out on old Austin. So that is episode 90. Oh, let's see. I feel like we're past that. Why does it say we're good? All right. But anyway, peace out, everybody. Thanks for listening. Glad you're with us.
Happy Memorial Day weekend.
Yep. Happy Memorial Day weekend. Bye.